Good morning. For those who don't know me, I'm Charles Grant, Director of the CR. Welcome to this conference in Brussels on the future of the EU. Although many of us are interested in Brexit, this is not a conference about Brexit. As it happens, Michel Barnier, who's giving the keynote speech, may touch on that subject, I suspect, but for most of today we're going to be talking about the much more interesting and important subject and more positive subject of the future of the EU. Before we have our first panel on the future of the Eurozone, let me just kick off for 5 minutes or so on, to say a little bit about a new CR publication which you have on your seats, Relaunching the EU. This has a number of ideas for making the EU work better so that it can be a more successful organisation, and it's written by my colleagues and I together. In no way I can summarise it in 5 or 6 minutes because there's a lot in it. There's a lot of ideas on the future of the Eurozone, a lot of ideas on migration, both of which we're going to be talking about later today. There are ideas on how to make the rule of law procedure more effective, how to make the EU play a bigger role in stamping out corruption inside member states, how to prevent companies avoiding tax in ways they shouldn't avoid tax, how to make the economy green, how to encourage mobility amongst EU citizens. Lots of ideas for making the EU a more effective organisation. I'm just going to focus on one particular theme in the report, which is the idea that the EU needs to be more flexible. We have recently seen two, to some extent, rival visions set out for the future of the EU, one by Emmanuel Macron and one by Jean-Claude Juncker. Mr. Juncker has suggested that everybody should do the same thing. He wants to use the opportunity of Brexit to push forward for a federal future where everybody joins the euro, everybody joins Schengen, everybody joins the banking union. That's a perfectly legitimate and, in many ways, reasonable vision for the future. But I personally prefer the Macron vision, which is that of a multi-track Europe, where not everybody does the same thing. I think the Macron vision recognises that in a large and complicated European Union where different member states have different objectives and different priorities and different views of the world, trying to fit them all into the same box is probably not ideal. That effort may make the EU brittle and therefore less viable in the long run. And what we do in this publication is set out some of the reasons why the more flexible way forward is perhaps a more viable one in the long run. One of the arguments that the Eurosceptics like to put forward is that the EU is a juggernaut trying to impose a single vision of Europe on all the member states. And I think allowing a more flexible Europe is a way of avoiding that particular narrative. The trouble is, for those of us like Macron and the CR who favour a more multi-tiered Europe, a lot of people don't. It's not just the traditional federalists in Brussels who talk of everybody doing the same thing and don't like the tiers. It's also countries of Central and Eastern Europe who, for very different reasons, oppose this vision. They worry that in a multi-tiered Europe, those not in the inner tier, not in the Eurozone, will be treated as second-class citizens and not treated very well at all. So they are rather opposed to this idea. But Macron's views do have support. The Italian government, for instance, is very supportive. And somebody in the Swedish government recently said to me, look, we're never going to campaign in public for a multi-tier Europe because we might end up in the second tier being outside the euro. But in reality, that is the way the EU is evolving. That's the way it has to go. And one of the reasons why I think it will continue to go in that way is because the Eurozone, as we'll hear in the next session, is going to integrate in some ways further in the future. That'll make joining the euro a more daunting task than it is today and make some countries realise either that they do not wish to join or that they probably should not join. And I don't agree with many of the people in this town who think that everybody will ultimately end up in the euro, even if most of them probably will. One other aspect about this flexible Europe is what it means for enlargement. Macron, in his Sorbonne speech, did understand the link between flexibility and enlargement. He makes the point, and I think he's right, that so long as we say that everybody joining the EU has to join absolutely every policy, that'll mean that enlargement doesn't happen. Because voters in too many West European and indeed East European countries are very reluctant to see a lot of Balkan and other countries not in the EU join the EU because they worry about impact on labour markets, for example, they worry about other things. But if countries seeking to join the EU were able to join not all the policies but most of the policies, that could make enlargement a less scary proposition to electorates in existing member states. So I think one way to revive enlargement is to return to the idea of the privileged partnership that Angela Merkel floated more than a dozen years ago in the context of Turkish accession. I think flexibility matters not only for enlargement but also for the neighbourhood policy. The neighbourhood policy has largely failed, as we describe in this report. When Romano Prodi invented it in 2004, it was supposed to create a ring of friends around the EU by offering trade, aid, access to European labour markets and political contacts. But the EU did not offer enough. So with a few partial exceptions like Morocco, Tunisia, in some ways Georgia and Ukraine, the neighbours have not turned out to be a ring of friends. Many of them have turned their backs on the EU because the EU has not offered enough. But if the EU was to offer participation in certain policies without these countries actually becoming members, then maybe the EU would have more influence in its neighbourhood. Now, obviously, there's a limit to how far you can go with optionality. The EU already de facto has variable geometry, of course, with opt-outs from areas like police cooperation, Schengen, the euro and defence cooperation. Which areas could we extend that principle to? Well, I think there's no reason why corporate taxation shouldn't perhaps be an area that some countries do more in and other countries do a bit less in. Security databases, the European Public Prosecutor, future intelligence cooperation. I mean, the list is not definitive, but I think there are other areas that could be optional. Some areas should not be optional, and I think that everybody in the EU who counts as a member of the EU has to be part of the single market, trade policy, environmental rules. I would say foreign policy too, though I think some of my colleagues disagree on that. And of course, what I'm saying also has implications for budgets and accountability, as Macron has recognized. If not all countries take part in all policies, how do you make sure there's proper democratic accountability? The answer is you may need extra systems of accountability for some of the core areas, like Macron has proposed a new element of the European Parliament to hold the Eurozone to account. He's also, of course, pushing for a Eurozone budget, and I think he'll get his Eurozone budget. That does make the EU more complicated, which is not entirely a good thing, I accept, but I think it's the way it's going to go. My last comment on flexibility is this. It does have implications for Britain, of course. Some of you may recall a paper published by the Bruegel think tank in August of 2016, written by Jean Pisani-Ferry, who is close to Emmanuel Macron, written by Paul Tucker, a former Deputy Governor of the Bank of England, written by Norbert Röttgen, who's Chairman of the Bundestag Foreign Affairs Committee, and by André Sapir and Guntram Wolff, two Brussels think tankers. The Bruegel paper did propose what they called continental partnerships for the EU, for countries not in the inner core of the EU. They suggested that most countries would join the euro and be much more integrated, but they said that countries like Britain and Switzerland and Norway, and in the future perhaps others like Ukraine, might want to wish to be continental partners in the single market, consulted on its rules without a vote on its rules, forced to accept ECJ rulings, but not forced to accept EU rules on free movement of people. Now, that paper went down really badly when it was launched in Brussels, Paris and Berlin, because it looked like it was sort of giving the British, allowing the British to have their cake and eat it. The timing was not good, but in the long run, I think it is a possible way forward, and some of the ideas in that paper will come back in 5 or 10 years' time. And I see Jean-Claude Pires there, who's been pushing these ideas of flexibility longer than I have, but I've come round to his way of thinking on that. And I think in the very long run, when the British have experienced the chill winds of solitude, and when they've worked out that life on the outside is not very good for their economy and reduces their voice in the world, and when the EU has worked out that holding the British at arm's length is not particularly in the EU's interests, either economically or strategically, then the kind of ideas in the Bruegel paper and the kind of ideas that Macron is floating and the kind of ideas that are written up in some detail in this report will come back on the agenda. I'm going to stop there. I'm sure we'll come back and discuss these ideas later on in the day, but let's move, if we can, straight away to our first panel on the Eurozone. Can I ask the Eurozone speakers to come and join the panel, please? Thank you. Münster, University of Münster, Luis Garicano from the LSE and the IE Business School, Hélène Ray from the London Business School, and Martin Sandbu from the Financial Times. Despite today's somewhat alarming news from Berlin, clearly Eurozone governance is going to be on the agenda next year. We have a lot of ideas bubbling up in Paris on Eurozone governance. We have a lot of resistance to those ideas in Berlin and in other European countries, but many people, including in Berlin, believe that there will be some progress next year, that Merkel, assuming she is still the Chancellor, I think she will get together with Macron to develop some new thinking on Eurozone governance, particularly areas like Eurozone budget and a European Monetary Fund under discussion. But I'm not the expert on the subject. Our panelists are, so Johannes, would you like to kick off with 5 to 7 minutes on what you think the future of Eurozone governance is, please?
Yes, thank you. Thanks for having me. And don't ask me what will happen in Berlin. I can't. Yeah. I'm clueless, as I think everybody is. I would like to stress, I think, one point on the general question how to proceed with the governance of the Eurozone. The European Union in itself is based on the subsidiarity principle, which you could operationalize like we should centralize as much as necessary and decentralize or leave decentralized as much as possible. I think this is based on the implicit assumption that we can, if we want to give up the benefits of decentralization, that we can centralize as much as we want. And I would like to make the argument that I think there are limits to this. The thing is that I think in recent years we learned that there is not only the need for cooperation, but we have strong national or even regional identities. If you look to Catalonia, Scotland, and national identities like Poland, Hungary, but even Italy, France, and Germany. And if we try to centralize in the presence of these strong identities, there may be, this may in a way backfire. So centralization in the presence of these national identities may lead to, from the start, to strong resistance against this centralization. The tasks that are centralized may have less support than before. When you think of redistribution, right? So redistribution at the central level. When you look at the United States, there's less support for redistribution because of this this large unit at which this is done, right? And of course, less control. So the question is, what can be centralized and what cannot be centralized? I think we have some experience by now, and we can see that centralization works well with more technocratic tasks like banking regulation, competition policy, and even monetary policy. Even though this is, of course, a highly political task, we have some experience in doing so. We have we are used to the idea that this is done by technocratic institutions. I think it works less well with the tasks that are more associated to national identities, like labor market policies, redistribution, and fiscal policies. Okay, so let me apply this idea to an example, and let me take the proposal for a common budget for the Eurozone. In principle, this is a good idea, and so the reasons that, for example, Emmanuel Macron gave for this common budget are sound. So stabilization of aggregate demand, policies directed at fostering growth, and so on. But so my prediction, given that there are limits to centralization, is that this common budget will rather be small, that it cannot be used for mitigating idiosyncratic shocks. That means there will, from my point of view, there will be strictly proportional use across countries. That means Germany and all other countries will make sure that they get their part of the money back. There will not be political support of using this money when a big shock occurs, and the money should be concentrated on a specific region in the Eurozone. And this is due to the lack of a common idea, and this is due to the lack of political support that could be the basis for centralization. To limit, due to the time limit, I think that the same is true that we have seen this with centralized debt rules, which lack the idea, which lack the political support, and so we ran into these large deficits before the euro crisis. And this is true even for structural reforms. When Brussels says you should do that, and there's no ownership, there's no sharing of this idea in the member states, this fails. So let me summarize. My idea is centralization may be good as an idea, but it may not be as easy as it is sometimes assumed, and this half-hearted, halfway centralization may backfire in the sense that I just described. Thank you.
Thanks very much, and thank you for keeping to time. Lewis, are you as fairly rather pessimistic like Johannes?
Yeah, things seem a bit stuck right now with respect to economic and monetary union. I will say why I think so and what can be done. I think the Commission document of the 31st of May, and then see where things are moving from there. Remember that they start by talking about completing banking union, and there is a very ambitious statement of objectives in the document with respect to banking union, the creation of a common deposit insurance and a common backstop for the European Resolution Fund. And they thought at the time of 31st of May that this could be done by 2019. The other element of completing the banking and union would be the SBBS. Together with Marcus Brunner-Meyer and Philip Lane, who's now the Irish Central Bank, a large group of economists, 7 or 8. We proposed that in 2011. It's been on the table since then. It's basically the idea is, we call them SBs, we call them European Safe Bonds, but basically the idea is that there would be a European debt agency that would buy the sovereign bonds of the European countries and issue a junior and a senior security. The senior security would be a safe bond with zero risk weight, would help diversify the financial system and make the banks more robust. It would avoid panic's flight to liquidities to the north. The flight to liquidity would be to this joint security, and avoid introducing joint liability, because the securities don't involve at all any joint liability. There can be default on any of the components. The senior bond will still be solid. As I was saying, these three components that I have just mentioned, the common deposit insurance, the common backstop, and the SBBS, are kind of a bit stuck. Before I explain you why I think they're stuck, let me just say quickly that there are two other proposals on the table. One is the e-bonds proposal, and here the idea is, it's a bit like seniority by buying. It's basically, the idea is that the Commission, it's like the IMF. Some institution buys bonds, and the countries are fully committed to never defaulting on those bonds. Thus, these are the senior bonds, everything else is the junior bonds. They buy the bonds according to some common key. This doesn't require lots of new institutions, but it does introduce, relative to the SBBS that I was talking before about, it does introduce some joint liability, which makes it unpleasant to the obvious countries. The other possibility, on the other extreme that is being discussed, Germany is putting forward this proposal of accountability bonds, which are introduced tranching but not joint. The idea of the accountability bond is that the individual countries have junior and senior tranches, and that the junior tranche is automatic as the result of a situation, for example, of budget deficit of 1%, or of not fulfilling some condition on SGP. The idea is that that's going to give incentives for good behavior. Automatically, the moment it's said that these new bonds issued are junior by definition, then, of course, the cost of those bonds are going to be much higher, and that's going to give good incentives. So that's the proposal. Those are the three things that are on the table. One is more ambitious, the Commission e-bond, the German accountability bond, or I wouldn't call it German government. I mean, German is being talked in Germany. Accountability bonds are basically have no European component. It's more of it's pure disciplining device. As I said, all of this is kind of stuck. It's been difficult to form coalitions, I think, very much from the outside. The three issues, they're giving risk weights to the sovereign exposures of the banks to induce diversification is not advancing. Many countries are opposed to this idea that the sovereign risk weights should have, the sovereign exposure should have risk weight in order to induce some movement towards this kind of joint asset. Deposit insurance is stuck, and the SBBS is stuck. The trade-off that could happen is that some countries would be willing, in the northern countries, would be willing to give up their safe asset and get a common safe asset, but would want some risk weights on the non-common asset. I think that wouldn't be a bad thing. In fact, I think it would be a very good thing for bank stability. But at the moment, there are those who want deep federal union, and they don't like this in-between SBBS kind of solution, and those who want market discipline, and they want these other solutions, like I told you, with national debt tranched. So right now, it's basically all of this package is, I think, in limbo, although some of you might be able to give us further thoughts on it. I would say, at the minimum, my recommendation here would be, at the minimum, let's eliminate the risk weight on the senior tranche of this common SBBS and see whether it takes off and start slowly and get people to start taking some risk. I think that wouldn't be very complicated. It just needs a Commission regulation, and it doesn't mean changing the risk weights of the national debt. The other component of the Commission document was the SGP, the fiscal authority and the fiscal rules. I would say I was disappointed, and I didn't like the SGP discussion. I think the SGP discussion, the Stability and Growth Pact, has been a complete failure. I think it makes Northern Europeans upset that Southern Europeans are not fulfilling their conditions, and Southern Europeans upset that Northern Europeans are meddling. So it kind of involves the Commission in the heart of what is the sovereignty of the states, and in that sense, I think the Commission should not be proposing simplifying the rules. It should be allowing actually for different countercyclical policies, different stances. That's what it should be. That is what should happen. And what we need, as Sedlmeier and Lee Buchheit and others have suggested, is a simpler sovereign bankruptcy procedure in the Eurozone that would allow for private debts to be reworked with private creditors, sovereign debts with private creditors. Once the European safe bond is in place and the European deposit insurance is in place, a sovereign mechanism of bankruptcy shouldn't have actually major systemic implications. And finally, unemployment insurance. The Commission says there is no stabilization or risk-sharing element. The Commission in that document very, very timidly said, oh, you know, we should start some central stabilization function. I think in that component, that's my last point, is also too technocratic and too timid. I think that the package needs some, not just symbolically, but also economically, some counter-cyclical element. And I think unemployment insurance would be ideal in the sense that people would think, oh, it goes then from north to south. Always that's not the case. You can make it relative to a moving average. You can stabilize the unemployment around a moving average. So when you're worse than your moving average, you get transferred, and you're better, you don't. You transfer. And my view is that it could be a great design, not just symbolically and not just to see Europeans sharing some of the upside and downside of the boom-bust cycles, but also because it could be a mechanism for importing good institutions into southern countries. We could have a contract that gives rise to this insurance, that it would be a single contract along the lines proposed by Tirol and Blanchard, and that could actually allow for a much better, flexible, and flex-secure labor market for all those people. So my sense is, I think Charles was saying some of this, pointing in the same direction. My sense is that Europe is going to want, Macron and Merkel are going to want to talk about big picture, defense, interior, borders, and I think those things are really crucial. But I don't think we should leave economic union to the next crisis. I think we've made good progress, and I think without antagonizing on these identities, that I agree that it needs to be carefully thought out. We can do substantive progress on finalizing the banking union, financing the financial union, and getting some counter-cyclical elements that allows, however, for fiscal stabilization on the national grounds.
Thank you. So basically you're saying fix the roof while the sun is shining.
Yes, I would rather do that than wait for the next hurricane.
Hélène, do you think Mr. Macron's going to persuade his EU partners to go along with some of his ideas on Eurozone reform?
I think Mr. Macron is a very persuasive man. And I think it's clearly a window of opportunity is open right now. And I'm fully with Luis on the fact that it's a time to act when growth is picking up. And maybe it's masking a little bit some of the structural weaknesses that we know the euro area has. But we cannot wait for the next crisis to actually fix it. Because what the past crisis has shown is clearly that the institutional setup and the governance of the euro area has delivered so far very suboptimal outcomes. So we need to act, and we need to act now. And it doesn't mean that we don't need to act on the big defense, border issues, etc., at the EU level, etc., but we do need also to think about the euro area governance. So let me talk a little bit more about that now. So I think it's clear that there's some lack of proper governance in the euro area, there's some incompleteness in the euro area design. And so just to give a few examples, there has been a proliferation of fora with member states. We have the Eurogroup, the ESM board, the ECOFIN, the Euro summits. We all have different decision rules. There's a huge lack of clarity and democratic control in this fora. I mean, if there is any democratic control, I mean, think of the Troika and all that. There is a lack of clarity in who does what and in which capacity. So as a result, there are two, I would say, main legacy of the crisis. On the economic side, it's the debt, the legacy debt, and on the political side, it is mistrust, generalized mistrust. So what should we do, and what kind of institutional reform should be done? Well, I think the first thing is that we should still be guided by the subsidiarity principle and but taking into account the very important externalities across the member states. And this is, of course, because a federal state is probably not in the cards for the moment. But one of the very important principles as well, I think, is that we need to think of the various institutions as an integrated package. So if you think about monetary policy, financial stability, including crisis intervention, fiscal policy and structural policies and their governance, it should all come as an integrated package. You cannot really separate the various areas. It's particularly obvious when we talk about issues such as fiscal policies and fiscal rules and potential debt restructuring. As Luis discussed, this cannot be discussed separately from financial stability and whatever banking regulation you're going to have, in particular for sovereign debt holdings of banks, for example. So this is why all these issues are linked and they come as an integrated package. Now, the difficulty of coming up with a realistic package, and for Mr. Macron to convince people, I suppose also, is that you have to have a package that speaks to the moral hazard, the fear of the German position, the suspicion of the French towards market discipline, and the fear of the explosive legacy debt by the Italians, just to name a few issues that you have to reconcile when you try to build an integrated package. So let me take a few examples of the policies and the governance that could be improved. So on the monetary policy side, clearly we have one of the best governance probably. The ECB governance is well defined. You could say that we need to make clearer the lender of last resort function of the ECB. But this is where, in a way, most of the progress has been made. On the financial stability policies, we have a banking union, which is a big progress, but we're still missing the deposit guarantee. We need a better backstop for the resolution fund. And we have had issues between DG competition and financial stability. So who is in charge of what here? That has been quite a bit of a problem. And of course, we need to deal with the bank sovereign debt holdings. And there are various options that can be thought of, from some kind of senior, junior type of safe asset that Luis was discussing, to concentration limits, thinking about risk weights, etc. We also have macroprudential policies, and they are mostly national, but with some coordination at the euro area level, and that is the way they should be. You have to keep the national component. It's extremely important because this is a way of modulating credit growth across the different regions when we have a common monetary policy. What is obviously very much missing is still the capital market union, which would ensure better risk sharing. So on this, we need to construct the relevant infrastructure, very much still in the infancy. Now, maybe the most difficult issue and the most important issues that have to be taken is the way we think about fiscal policy at the euro area level. The current system is not credible. It has been made abundantly clear about what had happened in the past. It's not credible. It's detrimental because it's pro-cyclical. It is based on annual deficit rules which have no a much more counter-cyclical system, which is pluriannual, with pluriannual rules. And we have to give back more autonomy to the sovereigns, so more also ownership to the sovereigns of their fiscal rule. So for that, there's a number of possibilities. We can go to pluriannual rules which have to do with nominal expenditure, for example, type of rules that the IMF thinks are the most transparent and the most credible, with medium-term debt targets. Instead of having an annual budget rule which doesn't make sense, you can have a target which is implemented using independent national fiscal council and coordination at the European level. And in order to make the system more credible, but at the same time to give more authority and more autonomy, you may want to shrink some of the debt, and there are various ways, again, or you can think of mechanism which would be a little bit maybe less overwhelming, with some was mentioning, but they have to be there has to be a lot of very serious guidelines there to make sure that you don't have loss of market access during the transition, that you don't have financial stability issues. So this all is very tied together. So there are various options, but I think the kind of ideas of having both more credibility via some restructuring in the system and more independence and more autonomy authorities is the right way to think about this issue. Dealing with some of these aspects of restructuring, and there the legacy debt looms large in how we want to deal with the legacy debt, and this has a bearing on how we think about restructuring, how much we want to restructure, flow versus stocks, etc. The ESM could also be at the center of the creation of a euro area safe asset if we were to go that way with some senior and junior tranches. And the ESM could also, like the IMF, be in charge of current account imbalances, except that it would have to have teeth when a country has large current account surpluses, unlike the IMF. So there again, we would have to think about tools that the ESM could use to enforce its surveillance on external imbalances. Now, the ESM, if it were to morph into a European Monetary Fund, should be an independent authority, but of course accountable, presumably to the European Parliament or to some sub-component of the European Parliament, which would be more euro area focused. And this would be the same if we were to move to a macro with some borrowing capacity or not. Then we would have also to have parliamentary control on that, and that could be achieved as proposed by various people, by a subset of the European Parliament, which would mix together presumably national members of parliaments and European MPs. Now I think, why would we need a finance minister and a euro area budget? Well, there are very good economic reasons for that. One which has not been mentioned is that when we are at the zero lower bound, like we have been, and we still are, and we might still be for a while, and we might still be in the future for a while because nobody exactly knows whether these low real rates are going to go away in the near future, then a fiscal capacity is the only way at the euro area level to really get out of this zero lower bound and the liquidity traps, let alone thinking of uncommon shocks, and that could be undertaken by the centralized budget, for example, on green energy infrastructure, etc. So let me stop here because Charles, I think, is getting nervous.
Okay, well, if you do finish your paragraph.
No, this is fine. I think
fine.
we can stop
Thank
here.
you, that's great. Finally, I turn to Martin from the Financial Times. Martin.
Thank you very much. I'll stay out of the weeds of the sort of specifics and technical discussions that some of my colleagues on the panel have done so well, and just try to set out some principles. And I'll start by saying that the question, as it's put in the program, who should govern the euro, is ill-defined. I don't say that to offend the host, but it gives me a good way of sort of delineating some of these principles, because in Eurozone states or policies of the broader economic policy regimes, including labour markets and social policy and so on. These questions will have different answers, so we need to answer them separately. Who should govern these various levels of economic policy? And sometimes, in fact quite often, the answer to who should govern should be no one and everyone, because it may be an obvious point, but it's worth restating that Eurozone economies are and should remain market economies. And a lot should really be determined by the decentralized individual decisions of people and businesses. Not everything has to be governed by either national or central pan-European levels. Let me say a little bit about those three main levels of policy in turn: fiscal, structural, and monetary and banking. On fiscal policy, I'm at sort of an extreme point of the spectrum, I think, in the general discussion at least, in thinking that there's much less case for centralizing either control of a national fiscal policy or carrying out centralized fiscal policy, either transfers or stabilization. And I think, in fact, we could go in the opposite direction and repatriate more national power over fiscal policy. And the main reason for that is that I think the main arguments for either centralized control or for centralized policy making don't really hold up very well because among countries through completing the banking union. It's worth bearing in mind that in the US, times more stabilization of asymmetric shocks in individual states than fiscal stabilization does. And the moral hazard problem many worry about Mario Draghi gave several speeches arguing that there was a case for more joint control over broader economies are run. And the argument was essentially that it's necessary to make sure that these policies are sufficiently good at the to leave the euro than to stay within. Forms, you have it in the use of... here too, I think we should be much more relaxed about letting national governments do their thing. And for sort of roughly three reasons. One is that countries are different. Different citizenries have different policy preferences, and different countries have different objectively economic needs that have to learn from diversity. We should not want countries look pretty similar in structural policy terms. If you think about how much intellectual influence the German Hartz reforms also on national policy thinking, I think that illustrates how it's useful to have a variety of models that countries can learn from. That will involve some failures, some things won't work. But the contestation of which model is right for a country should really happen at where the most significant political and democratic at the national level. So this is something that really should be national governments. I said 3 reasons, right? Can I remember the last one? What did I say? Diversity, difference, learning from diversity. I'll get back to the last one if I can remember it. Finally, monetary matters. So I don't want to say only monetary policy. In one sense, of course, monetary policy is run in a centralized way. The ECB is the central bank of the Eurozone. But actually, if you think harder about it, monetary matters remain still much more decentralized than they could be. So I wanted to dwell for a second on the fact that in every modern economy, money creation, the money creation process isn't actually run by the central bank, or at least not directly. Money is created, and to the extent that it's destroyed inside the private banking system, in the lending decisions of private banks. So virtually the entire. Now that is one reason why no central bank in any advanced country has as much economy as I would like them to have. But it's a particular problem in a multi-country currency union. And that's because to the extent that banking regulation is national, this process of creating a common money will take different forms in 19 or whatever it's going to be countries. So it's even more chaotic than it is in a one-country currency regime. This is why I think it's crucial to centralize more in terms of banking regulation. The moves towards banking union are exactly right, but we should go much further because there has to be a common approach to whatever rules determine how money is created, that is to say, the regulation and supervision of lending decisions, and also how money is destroyed or contracted, which happens on the in the bust, if you like, when the money that's been created, sometimes in completely uncontrolled ways, turns out to be backed by assets that aren't good enough, and you will need to resolve the banks that hold that money or that issue that money. And so there needs to be even more harmonization and probably centralized control over bank resolution regimes. I would like to go even further. I think the ECB would do well to learn from some smaller central banks that have currency, e-cash. The Swedish Riksbank in particular has thought very hard about the need for there being a common central bank created electronic currency for individuals and businesses. That would be a much further and more radical step of centralization than that anyone is really thinking about in the Eurozone. And it would be centralizing power not just from national governments, but from private banks across the Eurozone. So, summing up, who should govern the Euro in fiscal and structural matters? I think we should move towards more of a repatriation of powers to the national level. And what is it? Right. It wasn't that, but let's get back to that. We'll get back to both. Fiscal and structural monetary matters, much more centralization to the pan-Eurozone level. Thank you.
Thanks very much. Thanks very much to all of our panelists for such an interesting set of thoughts. To look at the future of the Eurozone, we consider 3 models for sorting out its problems. The first is the much more centralized federalizing model with Euro bonds, a European finance minister, a big Eurozone budget and lots of central control of policy making. We think that would be best macroeconomically, but of course wouldn't work politically because electorates are simply not willing to hand over that amount of power to central institutions. Is a so-called responsibility union, whereby the no bailout are allowed to go bust if they misbehave. You were hinting a little bit about this in your own remarks, Lewis. So we would rely on the financial markets to police excessive borrowing of the euro, and that would discipline the governments to behave better. But when we look at that, we're slightly sceptical that the markets would actually behave in an efficient and rational manner and produce the discipline required. Also, there would be a problem in that the weaker members interest rates, which would not help them to converge with the stronger members of the Eurozone. So we dismiss that answer. And our conclusion in our own report is similar to what several of our panellists have said, which is we don't need a massive federalisation of decisions, particularly for the banking union, as several panellists have discussed, a bigger backstop. We would like to see the capital markets union moving ahead. We'd also like to see the ECB mandate modified so it can tackle shortfalls in demand without risking legal action against it, and also resort. And we also do think that we do think that there needs to be a framework to deliver a stable growth of aggregate demand in the Eurozone, as the Growth Pact just isn't really doing the job there. It isn't sufficiently counter-cyclical. And we're slightly worried about creating a job called Minister of Finance with a big title and no power isn't going to help anybody. It'll just, since nobody's prepared to give him a lot of power at the moment, we're not huge fans of that idea. We think a Eurozone budget could be useful if it's big enough to measures of ensuring aggregate demand in the Eurozone. But again, creating...
Wouldn't want the market to be disciplined, thinking that this small country or whatever country might be thrown out of the euro. I think that's chaos indeed, as you're suggesting. Yes, I mean, but we think one particular country's stability and that the banks are diversified, and once you have deposit insurance, you can actually have countries go bankrupt without going out of the euro. So have a sovereign restructuring mechanism that actually does its job as this extreme case, but that does the job of kind of.
Please do.
I just want also to add a precision on that. There are several ways of thinking about how to use debt restructuring. So, and you have really to distinguish whether to do it on the stock, the whole stock. Probably a lot of problems for financial stability. And if you are going to do that, you have to have a joint solution for in place a sovereign debt restructuring mechanism. You have to think of a transition period towards having a sovereign debt restructuring for some additional issuance of debt which would be in violation of some fiscal rules, etc., along the lines of the German accountability bond. And again, there, you should think carefully about the effect on market access, etc., and think of it in conjunction possibly with the ESM reform. But that would be certainly probably less dangerous from a point of view of financial stability. So it's not a, one solution fits for all. You can have several options. Transition path and financial stability, so banking regulation.
Okay, Martin.
Just want to follow up on that discussion. There's a lot of talk of the need for a safe asset, which I think generally means a safe liability, as in a way that governments can always be sure that they can borrow at a reasonable rate, which is really the liability side, as opposed to the asset side, where the argument is that financial investors need something, a safe benchmark asset. I just want to point out that even on this safe liability issue, there's a lot that national governments can just do on their own. If you look back, think back to the crisis. It was that they had 6 years on average, so that they would have to refinance 20–25% of GDP in 1 year. No country can do that if it's forced to do that, right? Even Germany couldn't do that. So it wasn't, it was the stock, actually, the rolling over of the stock that was a real problem. That's something out of the crisis national governments can do a lot about to improve. I mean, you just extend drastically your maturity profile. That, of course, costs more because you might have to pay investors for that, but that's as it should be. Governments from reducing their annual refinancing needs to a very, very small proportion of GDP that nobody would ever worry about a self-fulfilling run-on.
I am very much in favor of your agenda, but it seems to be, given the progress that we saw in the last years, very ambitious. And I think we have a need for some priorities, and I see two areas in which we need actions urgently. This is banks and debt legacy. So one of the principles could be, well, there will be another crisis at some point in time, and then we should be prepared. And I think we should have a list of priorities, and I think we talk a lot about stabilization of aggregate demand, which is important, of course, but it's something that could be done. I'm with Martin there in a decentralized way, but the debt legacy is something which will be a big problem in the next crisis to come, and zombie banks and an unstable banking sector will be detrimental as well. And I have the impression that we're running a little bit out of steam because we overburden us with an agenda which is overly ambitious.
Let's take some comments or questions or disagreements from around the floor. Who'd like to kick off with a comment or question? Okay, John, I can see John Springford at the back. If somebody could pass him a microphone.
Thanks very much. I just wanted to ask a political question, which I know for a bunch of economists is not necessarily the best, but I think it's quite important. You know, the fact that we saw the FDP walk out of the German coalition talks last night suggests that it's going to be very difficult to, for Angela Merkel to be able to lead a strong German government and potentially to make compromises with Macron. Macron's plans, as Johannes Becker suggested, are fairly comprehensive, covering both fiscal policy, monetary policy, and the banking union. And I think Martin has answered this question already, so it's really a question for the other three. If you could do one thing, if you could recommend one thing which it might be possible for the French, the Germans and the Italians and the other members of the Eurozone to agree, which would make the Eurozone a more stable place, what would it be?
Could I just make a suggestion before we answer that? Could people please wait till the coffee break before they use the coffee machine, because it's incredibly noisy. With that said, who'd like to kick off first? Maybe Johannes?
That's a difficult question. And as I said, I think debt legacy is something which is maybe the most important thing. And so your one condition that you mentioned is that Germans could agree to. I'm not so sure about that we could, I don't know, have a conference on the debt, the legacy debt in Europe, but I think that is what we should do. Okay, given the current atmosphere in Germany, the political situation, I'm not so sure that this is something that the Germans would be enthusiastic about, but I think this is the most urgent thing.
I've lived, I guess, Tobias Bach, Martin's colleague, he was in Spain when all these similar things happened during the coalition building, and who knows if there will be another election in Germany as well, and who knows where Merkel will be afterwards, and who knows if there will be the other alternative is a grand coalition, which might change things in a different direction than the one you're suggesting, and Martin was suggesting. So I'm not. It's very hard to read what only 3 or 4 maximum people know inside those rooms. I would say there is one path So I think the concentration, the diabolic loop is not dead. The banks have more concentration on their portfolios of their own debt than before, and on their own country's debt, and that means that the system is unstable, and that these bankruptcy ideas, whichever you want to take, the ones that, softer ones that Hélène was talking now at the end, or the harsher ones, any of them are impossible while that doesn't happen. So obviously, there is, as I told you, there is all this discussion that is not taken anywhere about putting risk weights on sovereign exposure. The countries don't want to be forced not to invest in their own debt. So how do we get the banks to stop accumulating this debt? I would say that start down a path in which you eliminate, you have a commission regulation that allows for these safe senior bonds that I was suggesting, SBBS, to be held without penalty, so at the same currently. Then assets, their asset base, so heavily accumulated on their own debt, and these instruments start growing, then, and their own country's debt, and these instruments start growing, then you start seeing less treatment of sovereign risk exposure.
The way forward is to take into account the different, you need a package deal, and so what are exactly the ones which we have been, I think, discussing. On the one hand, accountability, right? And this is the only way to put ultimate accountability, because we know that sovereign and growth pact doesn't work, not credible. So how much the kind of ambition, more flexibility, totally linked. You know, a kind of trade-off in all these things, which, you know, can be built together, and there are very many options there.
Okay. Martin, any final thought from you on that?
Precisely because you need some sort of package deal or compromise. But if I had a large magic wand that could give me one wish, if it was large, I would scrap. If I had a small vision and regulation to the central level, and I would want to use that for one quick fix right away that I think could go some way towards addressing Luis's priorities before we get some sort of synthetic safe asset, which is to change risk weights on a portfolio of Eurozone government bonds weighted, then you get zero if you hold everything, and then on deviations from that you will get capital weights, risk weights.
Advisors.
I have a question for importantly pointed out that there's a lot of interdependence, so you have a system dynamics view on the whole thing, which I think is key. And then you also point out there's little progress on capital markets union. Yeah. So one of the structural problems in Europe is that politicians live happily in their silo, academics live happily in their silo, capital market people live happily in their silo, and typically they meet always when they have to meet. That means in 2008, and then they drag on. And I think the US has many of their own problems, but that's definitely better. And you can measure it by a very simple fact. You look at the performance and the valuation of the US banking system, which is right now 30% above the peak of 2008, and the European system is 50% below the peak. And that's a real problem. So for everything, because it's interdependent, but nobody really cares. So question is, how can you see that overall be really tackled in a better way, and that people are not getting lost in technical details because there's so many interests, and focus on the 3 to 5 things which make interdependence really work. So without progress on capital market union, there cannot be progress on politics, and there's always, you know, feedback loops into these things. And that's also one of the reasons why the German coalition talks failed, because people have no trust. They didn't focus on the 3 key things. They lost, you know, everything in details. And so there was a lack of trust. Do you see any progress that people will work together and make these 4 or 5 things work on equal levels?
I mean, I wish. So obviously, it's a key issue to get people to trust each other again, and to have institutions that foster that. And so, in that respect, I think you are absolutely right that the capital market union is one of the very important missing bits so far, because we rely too much on debt, we rely too much on you know, bank loans, as opposed to more what we call state contingent assets in economics, which allow better risk sharing in the case of big shocks. And that's an issue because that means the risk sharing then has to go through other channels, but they are not there. So that's part of the problem that has been blocked, is that during the crisis we didn't have, you know, much transfers, we didn't have much debt write-offs, and we didn't deal possibly with NPLs as quickly as we should have. And so indeed a lot of the risk sharing which should have happened via these mechanisms, either market mechanisms or via the debt restructuring or via the NPL write-offs, and people taking losses when they should have been taking losses, have not been there. And then we have been stuck in the political system, and this has created a lot of resentment and some kind of power relation between creditor, debtor, etc., which we are stuck with as a kind of legacy of a crisis. So this is a huge issue. I fully agree with you. And so I think the way to get that going is to have this better risk-sharing institution, which I insist do not mean more moral hazard, because we can have better. That is in part to restore this kind of more autonomy, but also more accountability via, again, this kind of debt restructuring types of idea orderly within the euro area. So I think all that we have discussed, this change in financial regulation to support that, this development of a CMU which goes together with institutions, you know, bankruptcy, harmonization, and all that, which are still very much at their infancy. All that will enable a smoother risk sharing, and hopefully will take the heat off a little bit the power relations between the states. And that would help restore trust. On top of that, we need more accountability everywhere, and we need more this democracy funding, you know, within the euro area that we have lost a bit because of lack of transparency and people doing a lot of different things.
Okay. Johannes, brief word.
I think this is a very good point, and I think the legacy problems prevent of building better incentives for the future. I think many people can agree on incentives that could govern the Eurozone, but so the governments prevents this from doing. So taking up this proposal by Martin to put risk weights on government bonds, well, this would have the immediate consequence of having turbulences, right? So this is a great idea, but given that we have this large amounts of sovereign debt in the banks' balance sheets, and this large debts on the government balances, this may be right now not such a good idea, even though in terms of future decisions, this is exactly what we should do.
Not all disturbances are bad, right? I mean, if you impose this idea now, saying that you will have risk weights on sovereign bonds, but zero if it's a balanced portfolio of all Eurozone countries, the first disturbance you would have is that banks in different countries would want to sell their country's bond and buy other countries' bonds, so you would get an exchange. You would get a more Europeanized banking system. That's not everything, I agree, there would be bad disturbances too, but not all of them are bad, is my point. It would move us quite quickly. It would sort of expedite the journey to the destination we agree we want.
Okay, the lady in the middle there with glasses, if she could get a microphone. Yes, she's got one, yeah. Yes.
Thanks for your help. Yeah, it works, it works. I'm Bernadette Segol, I'm a European trade union expert. Mr. Garicano, you mentioned that the labor market policies had to remain at national level. I understand the reason for that, which are twofold. First of all, we don't have any constitutional or legal background for the EU to do that at European level. And secondly, for the euro, the only solution is pressure on wages and social conditions in general. But this is counterproductive because in the end, people are perceiving the European project as being against their interests. So I understand why you are saying that, but at the same time, I would like to know how you or we can fix the problem which is being created by this competition, this social competition in Europe.
So yes, I think that it's very hard to, for the reasons exactly you said, constitutional provisions on unionizing and things like that are totally different in every country. However, the way I see it is that I agree with you that you need, not just symbolically, but I think in practical terms, you do need a European effort on the employment side. Employment is really at the root of everything we are saying. Employment is, when you see the Trump vote is very much related. Everybody has their favorite correlation, I guess. My favorite is routine jobs. The share of routine jobs is highly correlated with the Trump voter. People are worried about the future of the jobs, about the future of employment, and Europe needs to be seen to be acting on this, in my opinion. So how can you put those two things together? The way I see it is, it wouldn't take a lot of money to put an unemployment insurance system at the European level, or at least a complementary unemployment insurance at the European level, that goes together with a European contract that workers can choose. So it wouldn't mean, oh, now we have a European regulation, but we have choice. And if workers choose that contract and they get the European unemployment insurance, then you can kind of break the current status quo by making that contract kind of become preferred, at least where it's superior to the national ones. And the usual disagreements are going to be about mutualization, about permanent transfer union coming from Germany, but I think the permanent transfer union idea is just not understanding the math of the moving average. I mean, you're not going to be giving to somebody who has more unemployment, you're going to give to the past 5-6 years average. So it doesn't necessarily mean one-way flows by construction, and it will help what I think is the bigger problem, which is not so much the need to mutualize those insurance payments, which I think Martin is right that at the end, in terms of fiscal transfer size, is not very large, but because I think you do need better institutions in the labor market. I think the labor market in many countries is in a very, very bad equilibrium, and I think Europe can help to solve one of the key problems. Active labor market policies, etc. Everything could be tied in. The policy is much better for everybody. So to me, coming from a southern country, coming from Spain, but seeing similar things in Italy or in Greece, etc., it's time that the labor markets got as much priority as the reforms of the cajas got. And indeed, the savings banks was not a European Union decision. It was not in their competences. Subsidiarity would say the cajas should be regulated by the member states, and indeed in Germany they are. But thanks to the financial crisis, the IMF put together a pretty serious package, and the banks in Spain now are totally modernized, unrecognizably reformed to an extent that 50% of the credit what was politically controlled in Spain 10 years ago, 0% of the credit is politically controlled today. It's a massive change in the economy that is going to have extremely good consequences. And that, hopefully, you could try to do in a much lower scale probably, but incrementally with a labour market package.
Thank you very much. Shall we take another question or comment from the floor? Any hands going up? In that, well, let me.
I'll make a question,
yes,
Martin.
Yes, yes.
I also wanted to answer. Can I answer yours? Or just follow up on your?
Yes, yes.
I mean, I find this idea very attractive in a more general sense. If I understand the idea, you create a employment contract that's a European employment contract, and people can choose whether to adopt it, and some regulation and legislation and security benefits, social security benefits, go with that. I think that's a very attractive idea that goes a little bit, that kind of gets us out of the centralization versus renationalization debate that is kind of a bit zero-sum, right? It's one or the other. This is in addition. And I think it's a principle that we can think of in much broader terms. So think about the capital markets union, different securities laws and insolvency regimes. There exists a European company form, right? It's not very much used. It could be improved or changed, and you could supplement it with a European securities law and a European insolvency regime, and companies that wanted it could use it to incorporate, and a capital markets union could be based around that. If you choose a European form, you will find it easier to access finance. That would be the goal. And maybe it's a solution, this sort of parallel governance is a solution that could be applied in many places that we haven't thought of. I just add at the end that this is little to do with the euro. These are good ideas for the EU as a whole. It's not specifically Eurozone governance.
I was just so one was deposit insurance, on which he's been here might not have, unless they have read your column, have not heard. So I thought they both were interesting.
So you're just asking me to throw two grenades into the room.
Yes, that's exactly right.
Well, very briefly on deposit insurance, I think generally the need for it is overrated if you have a central bank that does the job it should. I quite like Mervyn King's idea in his book of central banks as pawnbrokers of all seasons, I think is the term, where the idea is that the central bank pre-commits to lending against pre-decided and pre-priced collateral, and that you require banks to always have enough assets on their balance sheet to back all their liquid liabilities, so that in a crisis, you know what the central bank will lend, on which terms, that's been decided in advance, and so you can guarantee that all deposits could always be honored. And then, you know, others would have to take the hit if there's not enough left to pay other liabilities. So that's one grenade. The other grenade is on current accounts, where I think too many people believe that so-called imbalances are a bad thing. I think that I prefer to call them asymmetries, because I don't think there's anything imbalanced about them. Current account deficits and surpluses in a monetary union are sort of the point. One of the big purposes of the euro is to facilitate capital flowing from high capital countries with low marginal returns on further investment to low capital, poorer countries where investment could do a lot more good. It should be the normal state of the world that there are large surpluses in the core and large deficits in the periphery. And we should have in the front of our mind a goal where normalization should mean a return to those asymmetries. So that's grenade number 2.
Okay, so we should stop beating up the Germans about their current account surplus. Hélène, you're going to go on beating up the Germans, I think.
Now, I'm going to recall a little bit of history on two topics. So first one, the European unemployment insurance that Luis described was more or less proposed a few years ago also by the French Council of Economic Advisors. And at that time, it didn't go anywhere, but maybe it is time to revisit it, so it would be good if more people are indeed on board on this. And the second thing about history is that current account imbalances. So there was a Brookings conference in which Olivier Blanchard and Francesco Giacomo were making, and it was before 2006. I don't remember exactly the year, but we were seeing these massive current account surpluses and deficits for the euro area periphery. And the paper was more or less saying, well, that's great. Olivier Blanchard said, that's great, because this is exactly what we want in terms of efficiency of capital allocation, and that finally we are seeing some integration, financial integration. And then we had, obviously, the big crisis, and we found out that these current account imbalances were more a symptom of an emerging market type of capital flow symptom leading to a credit boom and then a massive financial bust than effective allocation of capital, particularly obvious for Spain, where a lot of productivity decline is linked to the financial system being overwhelmed by this external capital and has been allocated to very low productivity investments. So let's be a little bit cautious about massive current account imbalances based on these episodes, and also a lot of emerging market and financial crisis history. And let's be especially bound. When you have zero lower bound, then you cannot have a usual adjustment via the interest rate, and we also have obviously no nominal exchange rate adjustment. Massive current account surpluses are equivalent to demand suppression for the aggregate of distribution of demand, and current account surpluses means less aggregate demand in the whole area. So this is a little bit of a different macroeconomic situation, which should be taken into account.
Okay, next Mark Boliat, then Sophia Besch. Mark, from the Corporation of London.
Can I raise an issue on governance? A bit easier than the question you've just been answering. Agreeing on common rules is difficult, but tends to be much easier than getting common enforcement. And that seems to me, whatever the rules are, is going to be an increasing problem. And it's not necessarily one of lax enforcement or rigid enforcement. It can simply be of different interpretations. And I think we saw this some years ago when somebody looked at different. And with the same definition, you could got a lot of different answers depending on the methodology used in each country. Should we be spending rather more time looking at enforcement of whatever rules we have, rather than getting the rules right, and how do we do this?
Okay. Any of you like to pick up that one? Okay, Johannes.
Yeah, I think this is an excellent point, and there is at least anecdotal evidence that tariff law, which is completely identical across member states, is handled rather differently across member states. It seems to be that the interpretation some cultural aspect in it. I think this is a good point, and I can support this point by pointing to evidence from Germany, where we have a tax administration which is organized at the state level, and they collect the taxes that they then put into a common pool. And there is strong evidence that enforcement is lax in those states which are net payers, like Bavaria, for instance. Right? And I think that this could be a way forward to, well, at least play around with the idea to have a European tax administration. So leave the tax policy at the member states level, so to have the subsidiarity, but to have the enforcement at the European level. That could give you more instruments in committing on at least some deficits. So that's a rather visionary point, but yeah, it's an excellent point. I think this is.
Quickly, I think it's a really important question. It's a sort of fundamental difficulty. I think it depends a bit what area of policy you look at. I mean, in general, the EU is pretty good at the ECJ enforcing decisions that go to it, right? But there are policy areas that don't naturally go in that, use that enforcement mechanism. Fiscal policy is the whole Commission monitoring system. Banking resolution, the whole new banking union apparatus also wouldn't go through the ECJ, partly because by the time you could get there, it's far too late. And I think in those areas, I try to hint at the distinction between centralized control over national policy versus centralized policy making. So to the extent that you think that there needs to be centralized control, and that's a good thing, you might want to lift the whole decision making to the central level rather than have rules that are applied or enforced on national decision makers because of the political example. I think we should probably have much more teeth and powers at the European level in terms of bank resolution.
Okay. Sophia Besch from the CER.
Thank you. I was wondering what the panelists' thoughts were about the fact that in the past there have been crises that have triggered progress in the Eurozone. And if we are in a phase of recovery right now, what does that mean for the prospect of the kind of grand bargain, as Hélène was suggesting?
What does it mean for the prospect of the current?
Could you grand bargain?
So yes, that's the. I guess that's the downside of the Monet method, that we are all with a heart in our throats by the time panicking. The crisis seems to be a required element of the policy. That's why I started with it. I was very encouraged by the reflection paper last May, because the Commission seemed pretty upbeat that things could be done. I mean, to give deadlines for completion of the banking union by 2019 was kind of surprisingly ambitious for me. And I thought maybe they know something I don't know. Now it's starting to look like they didn't. If there's somebody who was involved with that document, I'd love to hear them say whether they've updated their deadlines or whether we still look into that. I would really sincerely wish that some of these few things that we have said that are not overly ambitious we can get movement on that. I mean, the unholy alliance we have now between the ones who want it all and the ones who don't want anything against the feasible, I guess it's the same alliance you get in Brexit between the ones who want the Singapore model and the ones who want to get rid of any market capitalism. So the alliance that you have now between the, let's say, Germany wanting kind of minimal change on European economic governance and the countries that want real federalism is stopping us from having sensible advances on things that everybody in this room should see as necessary, like some progress on risk weights, even in the way that Martin put it, without necessarily going towards a single asset initially, but at least having a risk-weighted capital key related portfolio of bonds. So if you have to, just to be clear, sorry, if you have the bonds in the proper weights, you get a zero risk weight. But the moment you deviate, you're starting to have sovereign exposures bear some cost. These kinds of things are absolutely necessary to avoid a big storm if a country enters into a period of turbulence. And as Johannes said, the truth of the matter is that the debt, the inherited debt, is still large, so we cannot rule it out. And what we have seen is that when crises take forever to happen, but when they happen, they are much worse than anybody expected. So I wouldn't want to just see that next crisis. I would wish that we can avoid that method for once and just get our house in order, at least in this one particular thing. I honestly think if the banks continue holding in Spain, and I think in Italy, and I think in France, they hold, selling Germany, they hold the biggest share of their own assets they held at the start of the crisis, of their own country's sovereign bonds. This is just a recipe for disaster in the monetary union.
Okay, Hélène, then Johannes, then Martin. But be quick, please, so we can bring in more people.
Yeah, very briefly, you're absolutely right that crises have been instrumental to bring change. We've seen it again with the big crisis we have been through and the banking union, which was is a very substantial achievement and was done extremely quickly because of this urge. Now, there's the hope, of course, that given the timing of French-German elections, or what we thought would be, a kind of togetherness for a long time, that also political leadership would also take a little bit the role of engine as a substitute for crisis. But it remains to be seen, especially given what happened last night.
Okay, Johannes?
Romano Prodi has said that in 1999 that he knows that the current system is not made for each and every circumstances, but that there will be a small crisis, and then there will be the political will to further develop the architecture. So what we would need right now, when I pick up your point, is we would need a small crisis, not a large one. The small crisis that pushes forward the reform agenda, and we could do so by just revoking the OMT program.
Yeah, it's as if it'd be useful to have a little war. I worry a little bit about this view that progress is forged largely in crisis. I mean, think about the Eurozone debt crisis. It led to terrible decisions, right? It provoked decisions that were really bad. Bailouts instead of restructuring, fiscal consolidation across the board, not just in crisis countries, monetary tightening, all of which caused a new recession, entirely self-inflicted, 4 or 5 years of unnecessary hardship. And then things got so bad that, yes, they moved to banking union and moved towards restructuring and bail-in and so on. So it's not so clear cut. I think maybe the memory of crisis is the important.
So one way to get this joint asset issued cheaply might be, and this new configuration of debt might be for as the central bank, as the European Central Bank exits QE. It could exit by selling packages of debt rather than individual bonds. So they could actually, little by little, create these synthetic assets, senior debt. And that way, the ones who buy it are going to be necessarily diversified.
Okay, can I just see a show of hands? Who's... okay, I've got one question I want to ask. Question I'm going to put to our panelists before we wrap up. The fairly obvious prediction is that when Merkel and Macron get together, they will agree that there should be a Eurozone budget of some sort. They will agree that there should be a European Monetary Fund of some sort. But what should be the governance of those two institutions, and what should be their main purposes? We all know that as regards the European Monetary Fund, the German finance minister, ESM, to become the European Monetary Fund, should be a Ministry in Berlin does not trust the European Commission to enforce the rules strictly and objectively. They think it's become far too political. They see the EMF as a rival that they can control more than they can control the Commission. So I share that German finance ministry view, but what should be a sensible compromise on that? And what should the role be? Should it actually be able to bail out countries in return for fiscal discipline? Should it be able to give countries money in return for structural reform? What should be the actual roles of the EMF? Similarly, for the Eurozone budget, Macron says it should be of a size equivalent to several percentage points of GDP, which I imagine is for the birds. But what should its task reward for countries that are good little boys who do their structural reforms? Or should it be something that is counter-cyclical to stimulate demand in a recession? Should it be, should it have a significant macroeconomic purpose? And what should the governance of it be? Many people want it to be independent of the Commission. I'm sure some people in Germany would like that. But Mr. Juncker has said it should be part of the broader EU budget so that he can control it himself, a sort of subdivision of the main EU budget. So could our panellists conclude by telling us, for both the European Monetary Fund and the Eurozone budget, what should their main roles and purposes be, and what should the governance be? Let's go in the same order as we started. Johannes first, please.
Yeah, I've already expressed my skepticism towards the common budget, and in a way, I think in principle it would be idea that this is a reward system for sticking to the rules at all. This is, I think, a quite paternalistic idea that the father, Brussels, set all the rules and the children stick to it or deviate from it and then are punished or rewarded. I don't like that at all, and I think this undermines the idea of having a common house, as we say in German. In terms of governance, both for the common budget, it's important that there's a narrow and explicitly formulated mandate that is clear from the beginning, because I don't think that it is feasible to have simultaneous democratic control. I don't share the optimistic view that the European Parliament is able to do so. It hasn't got so far the legitimacy, the outcome-oriented legitimacy. So that would be a rather technocratic institution, which makes sense because the EMF would have to respond very quickly in times of crisis.
Okay, Lewis.
Yeah, I also have some of those have gone over some of those. It appeared at some point before yesterday night that we will have a finance minister by January or February, a permanent finance minister job in the Eurogroup, and I don't know if that's as close as it used to be. The function to me that the common budget needs is just going to be too small for macro stabilization. I don't think that that's really in the cards. We have a common monetary union, flexibility on the state budgets to have individual stabilization, macro countercyclical policies at the country level. And as I said, that needs some sort of bankruptcy or ability to police those countries. So what I was suggesting is that the role of this budget should be much more just some risk sharing, unemployment in particular, and as I mentioned before, I'm not going to repeat myself, the idea would be the institutional improvement and the sharing of institutions of a better contract, etc., bound to this new European unemployment insurance. That would be, to me, symbolically and in practical terms, the biggest step that actually would be within the cards or allowed by the situation, by the politics.
Thank you. Hélène?
So on the ESM becoming, we could envisage the European Monetary Fund taking up some of the functions that of the IMF, that is to say for the euro area, that is to say conditional lending or unconditional lending in the case of lost market access for pre-qualified countries. So this would be but accountable, in my view. In terms of the budget, so indeed there are several visions. So one is the risk-sharing vision, just outlined by Luis in particular. Another one would be to be a little bit more ambitious and to say there are these common shocks and there's the zero lower bound. And when there is a zero lower bound for monetary policy, we need fiscal stimulus, possibly, and some, depending on, it's all tied, you see, depending on how we may be able to relax the national fiscal rules and make them less pro-cyclical, which would be highly desirable, then we would need less of this centralized budget. So there is a trade-off there. If we manage to get rid of the over-tightness of the Stability and Growth Pact, which effectively prevents stabilization by national countries, then we need less of a centralized budget for stabilization purposes. But if we don't relax the Stability and Growth Pact, then we need more of this stabilization at a centralized level. So it has to be fought together. But so if we need some of this stabilization for the zero lower bound for common shocks, then we should think of funding the euro area budget with some for example, more harmonized corporate income tax, that would make sense. And we should think about, so the funding would be cyclical, but the use of the money would be stabilizing, because it would not be cyclical if we think about investing that money in projects that would provide a positive externality for the whole euro area or for the whole European Union, and whoever wants to then finance it would also contribute to the financing.
Okay, thank you. Last word to Martin.
Yeah, I think, as Hélène suggests, for the EMF, it's, the answer kind of lies in the name, right? If it's going to be a European monetary fund, it'll be a European version of the IMF. So it will deal with crisis lending and conditions and so on. It will essentially be government-to-government lending in a crisis. So I find it inconceivable that it wouldn't be Eurozone governments sitting ultimately on the board, much like the ESM today. So I don't really see much change. I find very important the German ideas for predictable restructuring mechanisms in the case of a future EMF, rescue financing, crisis lending. So that the essential new role of the EMF would be to predictably subordinate the stock of outstanding debt for a country that loses access to market financing. That will both radically reduce the amount of crisis lending that would be needed. Remember that all the Greek lending, 230 billion euros or whatever it is, only about 10-11% went to cover running deficits. The rest was all covering outstanding debts and bailing out the banks. And if the absolute amount needed is much, much smaller, hopefully the conditionalities can also be lighter. On the Euro budget, it won't be something that's 1 or 2 or 3% of GDP will not be macroeconomically significant. National budgets are 40 to 50% of GDP. That's why they are strongly stabilizing. Even the unrealistic aim of Macron, even if he succeeds, it will not have a macroeconomically significant function. It won't even be very flexible, because I think it's unrealistic to expect a sort of slush fund that a finance minister can apply at will. We know how the MFF works, and it's going to be the same. You know, every detail of the budget will be fought over and set in advance. So the best I can hope for from the Euro budget is that maybe it can do some good work to support public investment in downturns by maybe topping up national budgets in public investment spending, provided they don't reduce public investment themselves. It could be something like that. It could be spent on common projects, cross-border infrastructure projects. All of that is as relevant at the EU level as on the Euro level. So I frankly don't see much economic rationale for a Euro budget, but I do see it as the probable political price to be paid for an EMF that does have political and economic rationale.
No, I didn't mention anything about the EMF, and I wanted to add something that didn't come up in the last round, which is this idea. I think it's Jeremy who's most pushing it. I think the Commission is also interested in this e-bond idea, and the idea is non-crisis lending. So the IMF would be a way to get a joint asset by simply without essentially new regulation to some extent, or without massive new regulation. Simply some debt gets bought by this EMF, and it issues its own debt, obviously. So then you have the transformation there. They buy debt according to the capital keys of the member countries. So they buy basically all countries, all debt, not just some countries. And then they buy it until a certain limit, like in the red bond proposal, red-blue bond proposal. They buy it until, let's say, 60%. So automatically that debt cannot be defaulted on, because that's like IMF, you just don't default on it, so that becomes senior, and as a result, the debt beyond that ratio becomes junior. This idea, I think, as far as I can see it, because it does involve joint liability. The country that defaults, if Portugal defaults on its debt, and all the implicitly junior debt that wasn't bought by this institution, outstanding, is just not enough to make it solvent again, then we will have to default on the other debt, which is jointly held, and it's actually a loss for every country. So I don't see this as being something that is going to happen, but that would be a further, just to put it on the table, a further function for this EMF that would completely transform it, of course, into a real, almost, well, much more than a dead agency.
Thank you very much to all our panelists for such a stimulating discussion. We have to meet again in 15 minutes. Sit down. It's a quick coffee break. Michel Barnier will be here in 15 minutes. Could we thank our panelists, please? Thank you. And sorry, one final thing I should have said. Sorry, can we also thank our sponsors without whom we wouldn't be here? IMF, Microsoft and MSD. It's thanks to them that we're here today. Thank you. Thank you very much. That's good. Yeah.